Hey there, folks. Today, we're going to dive into the intriguing relationship between inflation and interest rates. You see, inflation is like a sneaky thief that slowly creeps into our pockets, making our hard-earned money worth less over time. On the other hand, interest rates are like a superhero, helping to protect our money and keep it strong. Now, here's the fascinating part. When inflation starts to climb, our superhero, the interest rate, steps in to help. It does this by making it more expensive to borrow money, which in turn helps to keep inflation in check. So, the next time you hear about inflation and interest rates, remember that they're like a dynamic duo, working together to keep our money strong and our economy stable. Thank you for tuning in, and if you enjoyed this video, please don't forget to like, share, and subscribe for more financial insights. Until next time, stay financially savvy. Inflation and interest rates tend to move in the same direction because interest rates are the primary tool used by the U.S. Central Bank to manage inflation. 1. Federal Reserve Bank of Cleveland. Why does the Fed care about inflation? The Federal Reserve Act directs the Fed to promote maximum employment and stable prices. Since 2012, the Federal Reserve has targeted an annual inflation rate of 2% as consistent with the stable prices portion of its dual mandate. The Fed targets a positive rate of inflation defined as a sustained rise in the overall price level for goods and services because a sustained decline in prices, known as deflation, can be even more harmful to the economy. The positive levels of inflation and interest rates also provide the central bank with the flexibility to lower rates in response to an economic slowdown. 5. In August 2020, the Federal Reserve adopted average inflation targeting. This framework committed Fed policymakers to hold inflation above 2% for a time to compensate for stretches when the inflation rate fell short of that target. 6. Key takeaways: interest rates tend to move in the same direction as inflation, but with lags because interest rates are the primary tool used by central banks to manage inflation. In the U.S., the Federal Reserve targets an average inflation rate of 2% over time by setting a range of its benchmark federal funds rate, which is the interbank rate on overnight deposits. Higher interest rates are generally a policy response to rising inflation. Conversely, when inflation is falling and economic growth slowing, central banks may lower interest rates to stimulate the economy. How the Federal Reserve measures inflation. The Federal Reserve's preferred inflation measure is the Personal Consumption Expenditures (PCE) Price Index. Unlike the Consumer Price Index (CPI), which is based on a survey of consumer purchases, the PCE Price Index tracks consumer spending and prices through the business receipts used to calculate the gross domestic product (GDP). One of the figures provided by the PCE Price Index is known as the Core PCE Price Index. This excludes food and energy prices that are typically more volatile and tend to be less reflective of the overall price trend as a result. How changes in interest rates affect inflation? When the Federal Reserve responds to elevated inflation risks by raising its benchmark federal funds rate, it effectively increases the level of risk-free reserves in the financial system, limiting the money supply available for purchases of riskier assets. Conversely, when a central bank reduces its target interest rate, it effectively increases the money supply available to purchase risk assets. 1. By increasing borrowing costs, rising interest rates discourage consumer and business spending, especially on commonly financed big-ticket items such as housing and capital equipment. Rising interest rates also tend to weigh on asset prices, reversing the wealth effect for individuals and making banks more cautious in lending decisions.